Hi everyone, Douglas Yones here. We're live on the floor of the New York Stock Exchange, the home for ETFs, and I'm pleased to bring you the next installment of our education series surrounding completely the world of exchange-traded funds, exchange-traded products, and how they work with commodities. I'm joined today by three very special guests. I've got John Love. He's the President and CEO of United States Commodity Funds. I'm joined by Sal Gilbertie, President, CEO, and co-founder of Teucrium Trading. And last but not least, my friend Greg Collett. He's the Director of Investment Products at World Gold Council. Welcome, gentlemen, to the New York Stock Exchange.
Thanks, Doug.
So, we've got audience members at home that are going to span all different spectrums of understanding investment products. So we want to start out and make sure we level the playing field. We're talking about exchange-traded products, exchange-traded funds. Greg, I want to start with you. Please go at a very high level. What does it mean when we say, hey, it's an ETF or an ETP?
Sure. An ETF, it's essentially very similar to a mutual fund, except it has shares that are trading all day on an exchange like the New York Stock Exchange. So what does that mean? You can buy these shares and they will trade at or near the value of what the fund is holding. As an example, I'm with the World Gold Council. We manage gold funds along with our marketing partner, State Street. Every share out there is backed fully by physical gold bullion. And if you look at it trading on the exchange, it's trading really close to the price of that gold bullion. So it's just a very easy and convenient and cost-effective way to invest in gold, in our case.
A lot of my friends and family will often say to me, you know, help me just understand exchange-traded funds. I know mutual funds, and I always maybe take it too high of a level. But I say, look, you know, if you're familiar with the mutual fund idea and the concept of you can buy in here and get an investment strategy, it doesn't take too much to then think, okay, well, we've added a wrapper, right? And that wrapper allows it to sit on the stock exchange, which then means you've got convenience and access, right? Because each one of us out there, we've got our own brokerage firm. We can log into that account and we can access the products from each one of these firms without having to come directly to each one of you and open a brand new account. And I think that's really impactful. I want to come over to you, Sal, because today obviously we want to talk about commodities. Could you help everyone understand what we mean when we say commodities, right? And do commodities really impact our individual lives every day?
Well, they do. They most certainly do. I think that people don't realize they're using commodities every single day. People understand they got in their car and they drove to work, so they're using some form of energy. They adjusted their thermostat at home. But everything that you use, from the food that you eat, to the materials that build your house, to the car that you drive, all that went into it, those are commodities. Those are actually commodities, and all the components had to travel to the car factory, to your home, to the store where you bought them. Commodities are what got those things there, from energy to food products, to precious metals, to lumber. All of these things we use every day and you don't realize it. And you won't stop using them no matter what the latest iPhone is or what's happening to the stock market. Commodities are a really unique investment category that people should be paying attention to.
So John, that's a great natural transition. We talk about the idea of gasoline or oil. USCF many years ago made a lot of, real impact on the industry because you created this natural gas fund, you've created this US oil fund, you now have a gasoline fund. Help us understand, how is it you were able to take, let's say, oil and wrap it into an ETF, right? Are people getting a barrel of oil? How does it work?
Yeah, no, if you're getting a barrel of oil, it'd be a little hard to invest. So what we're doing, and usually when people talk commodities, it kind of depends on the commodity. With gold, you can obviously, it's a lot easier to hold the physical than it is with oil. So generally when people are looking at commodities and pricing commodities, they're looking at futures contracts. And so what we did is, rather than invest directly in oil, which is a very difficult thing to do unless you're a big, multinational corporation or a producer, a hedger, that kind of thing. We just invest in futures contracts. Futures contracts are not the easiest thing for average investors to get into. You can buy a future on a lot of brokerages these days, but when you open a futures contract, you don't just forget about it. You really have to maintain that position. You've got to watch and make sure that what your margin levels are. You maybe get a margin call if the commodity dips. You also have to roll the position periodically, maybe every month. So it's something that you have to maintain. What the ETFs do is actually kind of take that burden away from investors and make it very easy just to get that same exposure that you would get in the futures market in any commodity, whether it be oil or the ags like Sal has, or a broad basket of commodities. So that's what we've done, is turn the future into an equity, essentially.
Okay, so some of these products are structured in a way where they're owning futures, but as we mentioned, the largest gold ETF, which World Gold Council has, ticker symbol GLD, that's a little different, right? Because you're actually buying bars of gold.
We are. So for every, through the wonders of exchange-traded funds, and I think investors don't have to concern themselves too much with the mechanics, but what they should know is if they're buying a share, it is actually backed by physical gold. And that's what makes it just such a cost-effective and convenient way to get access to it, which to me is that's really the key with all these commodity funds do, whether it's the US oil fund, the corn fund, and whether they're futures-based or physical-based, they are making it easy for investors to access this in their brokerage accounts, and that's quite a trick.
So we obviously have this recorded, but we're going live right now. We've got investors that are listening and writing questions in. If you're at home and you have a question, please feel free to throw it in. I've already got a few coming in. I'm wondering, the first question I have, somebody to go deeper into what it means to create or redeem ETF shares. Could somebody walk us through that process?
I'll take a stab at it. What basically happens when you buy a mutual fund, you go out and you submit an order either through your broker or through directly with the mutual fund, and you just put in for the amount of shares you have. With an ETF, there's essentially only a limited number of authorized participants who can buy shares directly from the fund. So if there's, let's say, 1 million shares outstanding and there's more demand for shares, eventually those authorized participants, they're the market makers, will go to the fund and they will actually create more shares, so those get out on the market, get into the marketplace. And that basically means that investors, it's what creates this arbitrage mechanism that allows prices to be fair value, to maintain low bid-ask spreads, because the market makers, they can go create and they can redeem ETF shares anytime they feel the need, and that's what basically allows the arbitrage to happen.
Yeah, so it's an interesting process. Sal, I want to come to you because I'm starting to think for your products, right? In particular, corn, okay, right? Unlike maybe gold, where a lot of orders come in and the market maker, sells the ETF shares to the client, turns around and they deliver gold to the ETF. Are they delivering bushels of corn? What are they actually giving you?
Well, they're delivering futures contracts. So inside the corn fund, and like many exchange-traded products, we use futures, and we take the burden away from the investor of having to worry about the intricacies of futures trading. And in fact, a good part of the world does not trade futures, including institutions. Many institutions aren't authorized to trade futures. They're complex. They require a different skill set. These exchange-traded products allow anyone to get direct access to commodities, because we as the sponsors take care of all that inside of the exchange-traded product for you. So corn, when money comes into the corn fund, that money is put in by a bank or an arbitrageur into corn futures. We exchange shares for those futures with the bank. So from an investor's perspective, all they need to know is what's the price that exchange-traded product is trading at, where's the bid ask. Never use a market order, that's a good thing to say. Use a limit order. Put your order in, a bank will arbitrage to you. Your order, no matter how large it is, will not affect the price of the commodity. What happens is, if there are many, many buy orders, as John explained, we simply issue more shares. If there are many, many sell orders, we take the shares back. So we balance the market with the flow of shares. We're in a continuous IPO offering all the time. That's what an exchange-traded product does. Those are intricacies, fortunately, that an investor doesn't have to think about. They know they want exposure, be it up or down or whatever manner they want. They see the price. That price will not be affected by their order when everything's working the way it's supposed to, and it always does. It does vast majorities of the time. There are no issues. Even during some of the flash crashes, the commodities exchange-traded products were complemented by the regulators because they never missed a beat. And so this is a really unique space, and the exchange-traded product wrapper is a really unique wrapper that we didn't invent. At least we at Teucrium didn't invent it. We just put our things into it.
Yeah, we always talk about in the industry the impact of the exchange-traded product, in terms of transparency, in terms of allowing access, and it really has taken, particularly with commodities, the ability for individuals such as ourselves to now access an investment vehicle where maybe before you needed to be an institution or you needed to open a futures account in order to actually go out and buy and invest in these types of products. I want to come back to the pricing mechanism. So we're talking about futures, talking about everything from gold or copper. Let's talk about CPER, one of your funds. How do you actually price it? How does it that we can access the stock market and know, is it the price of copper? Is it what I would buy copper for my home? How does it work?
It should be very close, because at any given time what we do is we hold, if we have $1 million come into the fund, we buy $1 million of copper future exposure. And so the fund really has a one-to-one correlation to the price of the copper future itself. The only thing you get is potential slight impact from expenses, slight impact maybe from bid-ask, but generally if you look at the copper ETF and you look at the copper future or copper futures that are in the fund, the basket of futures, then you will see that it's trading alongside those things. CPER actually uses 2 or 3 futures at a time. It's based on an index, but it's essentially reflecting what is going on in the copper market, which is really beneficial to investors. So it's a great way to see what's happening with copper. Copper also as a commodity often is an indicator of what other commodities are doing. It's got the nickname Dr. Copper. So a lot of people look at it kind of as a indication of what's going to happen in other commodities themselves. So the ETF kind of gives you that price discovery mechanism.
You mentioned, John, the word index, and I want to stay with you for a moment, because some products do follow an index, but others don't. What we would always call it is actively managed. Could you maybe explain to the audience the difference between the two and why, and anyone could jump in, but this follow-up question, right, is why would you decide to either follow an index or just build it active?
Well, if you're going to follow just a single commodity and you want the purest exposure to that commodity, when you see on the news oil's up 1% today, I want to have a product that's up 1%, then you don't need an index. You can just invest in that front month future contract, and your performance should track that future over time. If you want something maybe a little more intricate or a little more, you want to experiment a little bit, you can do a basket of futures. We have a fund that holds the front 12-month oil futures in the futures curve, or the front 12 months of natural gas futures. And if you want to go beyond that and use, basically track, say, a broad commodity benchmark or something like that, that's when you go out to an index and an index provider. We use Summerhaven, and they put out a fantastic commodity index, SDCI, which essentially tracks broad commodities, and that's what the ETF invests in over time.
I think what all of us are talking about here, you mentioned managed or not, or actively managed or not. There may be a methodology that seems active, but in all of our exchange-traded products that are represented here, you want exposure to that basket of commodities or those specific commodities as an investor, and so you can buy or sell to increase or reduce your exposure to those specific commodities. Whereas an actively managed fund, which none of us have right now, that you're betting on another person's skills in buying or selling those particular commodities, and you are not guaranteed that if the commodity you want to own, when it goes up, that your fund will go up. So the funds we're talking about here are direct exposure. In our case, they're long-only unleveraged. So if you believe the price of corn or wheat is going to go up, you can buy our fund, and by and large, when the price of corn or wheat goes up, the fund will go up. If it goes down, the fund will go down. There is risk in commodities all the time. So, but all of these products mirror the price changes. That's the point here, to get investors direct, easy access, and they can make the decision with their advisor of what type of exposure and trading perhaps that they want to do.
Yeah, most of our funds are they're following just physical gold, and they don't need an index. They're elegantly simple. But we do have one fund that I think is just such a useful, or can be such a useful tool. The symbol is GLDW. It's the Spider Long Dollar Gold Trust. It's essentially, it's long gold and it's long dollar against a basket of foreign currencies. Economically, it's like buying gold in terms of those foreign currencies. What does that do? It can produce a lower volatility gold investment for investors. And so I just want to mention that because that does follow an index, and it's another example of how the ETF, you can wrap up some things that are really interesting and can be really useful to investors and make it very easy for investors to execute on that investment vision.
I think that brings up a great point, which is there's other types of ETFs out there that are other kinds of funds. They're called managed futures funds. That's where you're betting on a manager, a sell-side, to take active bets. What what we're doing generally with our funds is giving you that simple exposure. So we're not getting cute with the exposure. If you want to do something a little more involved, that's when you can go to an index. And just kind of look for a better way, maybe a little bit of better mousetrap. But we're looking for pure exposure.
So speaking of cute, I've got a cute question from the audience that I'm going to put someone on the hot seat. They're asking about hemp and cannabis, obviously big in the news. Is there a spot market or a future market for hemp today?
No, there's not. Hemp is because of the regulatory restrictions that have to do with hemp and marijuana. There are too many regulatory hurdles that have to be overcome. So there's no sanctioned exchange-traded market right now that someone could piggyback on.
For the spot market itself.
That's
and
correct.
Of course, there does exist ETFs that can invest in the overall industry and can invest in the companies that are legally working within their rules of each jurisdiction, but from a spot market doesn't yet exist. And I won't ask you to contemplate on if that ever changes, but I do want to change topics to something that is very relevant, which is the use of these types of investment vehicles in a portfolio. Right? How does someone at home that's speaking with their advisor or a DIY investor, how should they think about commodities as part of the overall investment in their portfolio?
Well, we think it's a fundamental, it's kind of the original alternative. You've got stocks, you've got bonds, where do you go to next? And we think that people should have an allocation to alternative asset classes, and commodities is obviously a big one. So I don't think that it's something that you want to look at, and most people are not going to change from a large allocation to commodities and/or bonds. But I think they should consider a significant piece of their alternative allocation to commodities. And the reason you're doing that is it's diversification. Study after study has shown that if you add commodities to a stock and bond portfolio, you improve risk-adjusted returns over time. It is just a great way, great tool, another tool in your toolkit. And to go without it is difficult. And I think especially right now, when you've got equities at all-time highs, commodities really are the only thing that looks like they, maybe have, at low valuations. They're really trading much below their, historic highs in a lot of different commodities. So it's something that I think people should look at. It's something that you want for diversification and for just, a long-term portfolio in general.
Sal, I'm looking at you because every time we get together, we end up having conversations about the price of wheat, natural floor for corn, sugar, right? You have CANE, cane for your sugar ETF. When you're discussing with investors or advisors, what are they saying with respect to adding commodities into a portfolio?
Well, they often ask how much should we add, and we can't really answer that question. That's up to each individual. As John says, there's study after study that proves that your risk-adjusted returns actually increase, meaning your volatility decreases a little bit and your returns either stay the same or probably slightly go up. Even if they go down a little bit, because your volatility has declined, your risk-adjusted return is going up. So commodities really help. Things are unique in commodities, so everyone knows they use oil. Everyone likes to own gold for a variety of different reasons. Grains actually trade at their cost of production. That's their natural state. Most people don't understand that agricultural products, because of the subsidies that farmers get, because of government support, because food and the grains are integrated throughout the economy now, people get paid to plant these crops, but they will not lose money. And so what happens is your crops kind of hit a floor, and they just kind of trade in a range around that floor, and then it stops raining somewhere. And as we said before, no one will skip their breakfast bagel, in the case of the wheat fund, if it doesn't rain in Iowa. Say everyone in New York's going to keep eating their bagel. And what happens is the demand is continually rising for grains because of the macroeconomic factors of global rising population, increasing middle class, which is raising demand for all commodities. But if you've got a commodity that trades at a floor, at a certain price, and then the demand stays steady, yet you have a supply disruption, Econ 101 tells you what's going to happen there. So commodities can be layered into a portfolio very intelligently. In the case of agricultural products, grains, corn, we were talking about that off camera, it's really at its cost of production right now. And you can look at a chart to find out what that is. When these things are flatlining, that's when you should talk seriously with your advisor to think about layering in an allocation with grains, maybe overweighting around a multi-commodity basket that you already own, and then you wait and you wait. That's pretty much the expression they use for us.
Greg, gold, gold, gold. Everyone has an opinion on gold. Doesn't matter where you go.
True.
I want to understand, World Gold Council, you're obviously thinking about when is the right time to be investing in gold, gold as an inflation hedge, gold as a hedge for market corrections. How do you discuss the idea of adding gold at what levels? Are there guidance recommendations out there? Let's talk gold.
Yeah, we have plenty of research that can help investors to think through what drives the price of gold. But I want to mention just one key driver that does not get enough airplay. So the things you mentioned, true, can be helpful in those situations. Diversifying your portfolio, also true. That gets a fair bit of airplay. One of the key drivers that does not is just global wealth rising around the world. Roughly 60+% of gold consumption is in the form of jewelry or technology. And so these financial factors that we hear driving the price of gold, that's not really affecting jewelry and technology so much. It's just rising wealth. Think China and India. That drives the price of gold up. So we think you should consider being a long-term investor if you have a stock and bond portfolio. It can diversify your portfolio, and historically that wealth creation has been pushing up the price. We recently launched a new gold fund. GLDM is a symbol, the Spider Mini Shares Trust, Gold Trust. It's relatively inexpensive. In fact, it's, I believe, the least expensive in the market at this point, and that will allow investors to be those long-term investors in gold.
Yeah, I was going to ask you about that. GLDM, the Gold Mini, GLD Mini. Yeah. Are they different in some way? Why did you need a second product?
Yeah. Well, our flagship product, GLD, it's extremely liquid. The trading costs are very low, so it is a fantastic product for all sorts of different investors, but particularly if you are really focused on trading costs, that is your best gold ETF bet. GLDM, it's focused on a slightly different market. It is focused on that investor that is really planning to hold gold for the long term. And that's why that yearly management fee, getting that very low, it's going to be very helpful to them.
So question from the audience, are commodities a natural hedge for any particular asset class?
A natural hedge for an asset class? I will move slightly on that one and say for inflation, yes. Inflation is not an asset class, but commodities are a tremendous hedge against inflation. I'll let these guys say if they think it's a hedge against another asset class. I think it's a diversifier, not necessarily a hedge. Let me talk two things real quick before I hit the inflation thing. One thing I will say as a hedge, this isn't exactly a hedge, but if you look at the last two equity downturns, the dot-com bubble bursting and the financial crisis, equities turned down, commodities continued rising for a period of time after maybe 6 to 9 months after those equity downturns. So it's not exactly a hedge. There's not a reason that stocks went down. There's not the same reason that stocks went down that commodities kept going up. And it's not necessarily something that happens every single time that occurs, but you can see that. There are different drivers for commodities and equities, and there are different times when one will do well versus another. So not quite a hedge, but it's certainly something that gives you the diversification that you're looking for. It's not so much that you want to predict, oh, I need a hedge against my other asset classes. It's that I want a continuous diversification tool in my toolkit that kind of provides a continuous mix. The other thing is regarding inflation. I know people are really not worried about inflation. It's been tepid for decades, but it has risen a little bit. It's kind of rising. Commodities historically have had great correlation to inflation, especially rising inflation and inflation shocks. Stocks and bonds don't. So when you're looking at an inflation hedge, if you're starting to get concerned about inflation, which I think people should have a little bit on their radar, at least some concern about over time, based on all the things going on in the world right now, commodities are probably one of the better things that you can get exposure to.
I think in answer to that question, in a different way maybe, is investors can look at it this way. If they own, say, airline stocks, the largest cost of an airline stock is its fuel cost. So if you're a good stock picker and you own airline stocks and they're in generally treating you pretty well, and you also own oil, when there's an oil shock and oil doubles, those airline stocks are going to take a hit that quarter. That's just what's going to happen. Now you're a good picker, so they'll learn how to operate in a higher price oil environment. But during that quarter where you lost on your airline stocks, you're going to make on your oil, and that's what actually reduces. That's how mechanically it reduces the risk in the portfolio. It increases the risk-adjusted returns. If you own chicken producers and their biggest cost is chicken feed, and the price of corn doubles, which it's done twice in the last 11 years from prices where it is right now, you're hedged. In effect, you're hedged. That's why a layer of commodities in a well-balanced portfolio really does help your risk-adjusted returns.
So, Greg, same question, but a little different from the audience just now. What are we looking at from an inflation expectation for the end of this year and through 2019?
Yeah, I love to answer audience questions, but I don't think that that's the way to look at gold investment. Again, I think investors are best served by looking at the long term and looking at what some gold in your stock and bond portfolio can do, which it can diversify it, it can lower the volatility in that overall portfolio and provide returns in the long term. So focusing on what inflation is going to do, I think investors are not particularly well served by that.
Okay, another question that's coming in, and by the way, we actually had a comment come in saying, great answer, thank you. So well done. Another question that just came in from the crowd, they want to understand position limits. So we understand that in the world of commodities, you can get to a point where you can hit a position limit, or you've maxed out, I guess. Does this affect exchange traded products? Is this something you worry about? How does that work?
At different times, it definitely can be, a worry. The regulatory environment can change, and I think there's a lot of misinformation out there. A lot of people think that, this around 2009, 2010, in the wake of oil and natural gas going extremely high, people were blaming speculation, which, there might have been a speculative premium, but it wasn't ETFs that were adding to this or long-only funds. But there was a lot of talk about imposing harder position limits, lower position limits than existed at the time. Certain commodities, there's different rules, but right now it's kind of subsided as a regulatory concern. It's always on our radar, but I think probably all of the ETFs that we're talking about, it's not an issue if you invest in physical. If you're invested in futures contracts, I think right now, the limits are high enough that there's plenty of room for growth in the ETFs. It just puts a ceiling on it if they were to be imposed at an artificial level. And unfortunately, I don't think anytime you impose an artificial ceiling on something and crimp supply demand of something, that can have an effect on price. So hopefully, I think there's been a lot of analysis on this, a lot of research done by economists at the different regulatory agencies, and so far they seem to have done the right thing in my view.
Sal, position limits, is it something we should be concerned with?
Not right now, no. No, I don't know of any ETF that's very close to position limits, like not even close. They're nowhere near position limits. The regulators also understand very thoroughly the implications of what these position limits do, that they do inhibit the flow of capital. They can be more harmful to markets than helpful. We did a lot of discussing with the regulators when Dodd-Frank regulations were put in place, and the regulators have a very thorough understanding and a good pulse on what's going on out there. There's no issue right now with any ETF with position limits.
So Greg, I have a question coming in for you and gold, and the question's around hedging out tail risk. Sure. And could you maybe explain what that means to the audience, and then how a gold ETF can help?
Yeah, sure. Tail risk is essentially unexpected events, and historically, gold performs well when unexpected negative events hit the markets. Our World Gold Council research shows essentially that the more negative or the worse stocks are doing, the more the correlation of gold to stocks becomes negative, meaning the more gold is likely to help your portfolio. And that really gets the concept of tail risk. If big bad things happen, gold will probably be doing pretty well.
Okay, next question coming in. They're asking for an explanation of the words contango, backwardization. We promised that even if you were a seasoned investor, you would learn during this seminar. Who would like to help us understand those concepts?
I would love to.
Okay, John, step up to the plate.
So contango is basically, it describes the shape of the futures curve. If the futures curve is rising, meaning prices are for each successive future, let's say March, April, May, June, if they're getting more expensive, that's a market called contango, or the market is labeled contango. The opposite is when futures prices are dropping, and that's called backwardation. And the key thing that investors need to know is contango is a headwind against your return. Backwardation is a tailwind. So it doesn't, if a market's in contango, what happens is you own a future, and eventually you've got to roll that future to the next month or the next point in the futures curve where your strategy tells you to go. So if you're rolling from, let's say, a $50 contract to a $51 contract, over time what happens, futures converge to spot. So if that commodity stays at $50 and you're rolling up the futures curve, you roll to 51, it comes down to 50. You roll again, 51, it comes down to 50. So you're paying essentially a premium almost to keep that position open. And that's called a roll return or roll yield, and it can be positive or negative. The opposite is, if you're in backwardation, you're actually rolling down to a cheaper contract that then converges to spot. And you are basically earning a roll yield, which is positive for the portfolio. Now, neither condition means that, contango doesn't mean that you're going to have a negative return. It just means that something's taking a bite out of that return. And backwardation doesn't mean you're going to have a positive return. It just means there's an extra component of yield that comes into it. One other thing about backwardation is it tends to signal commodities in low inventory. So if you look over the 2014-15, we had this huge glut in oil. The oil market was in contango, sometimes very steep contango. Right now it's in backwardation, which is signaling that supplies are much tighter. People are concerned about actually getting physical oil. So the market's backwardated, and that tends to be a positive. So something to keep in mind, but the key thing, contango, headwind, backwardation, tailwind, and if you want to know which way it's going, you can go to any futures site, the CME site, and just look. Are prices rising as you go out the curve, or are they falling?
Yeah, Sal, I'm wondering if you could expand a little bit. In particular, what I'm thinking about is when you go to the website or each of your websites, let's say, and you learn and you say, okay, it's in one of those two places, does that signal something? Does that mean directionally I should behave in a certain way?
Well, there are people that believe that, and statistically it's been proven that, as John said, backwardated markets tend to indicate lower inventories, and that may signal rising prices. I think what people need to understand is that inside the design of every ETF is a unique structure. So there are multiple ETFs in different categories, multiple oil ETFs, multiple gold ETFs. Look inside each one and see how it's structured. So if you're a short-term trader and you have an ETF that's holding, say, nearby futures or one or two futures contracts, that may be a suitable product for you. If you're a longer-term trader, you're probably going to look for an ETF that spreads its futures holding across the curve to mitigate these effects of contango and backwardation. Because remember, contango, another way to say this, at Cargill they taught us that contango was the cost of care. So if you're a grocer and you have a can of peas on the shelf, you had to buy that can, put it on your shelf, you're paying cost of money, you're paying insurance for your shelf, you're paying your employees. There's a cost to keep that can on the shelf until it sells. That's the natural state of commodities. When things are backwards, where the price of the can is falling, that's backwards, it's not natural. So that's why they got called contango and backwardation. It's very interesting, actually. But remember, when you own a commodities fund, and there's contango in that commodity market, each time you roll, you're buying a little less. So if the price is 100, and the next time the price is 101, you own about 1% less when you go to roll, okay? Well, that's hurting you when the price is going up or staying sideways. When the price goes down, owning a little less actually helped you. So there are instances where contango is not always bad, where backwardation is not always good. So what investors need to do is look under the hood of the exchange traded product they want and match them. Long-term holding, make sure your underlyings, the benchmark is a spread of futures contracts, multiple futures contracts. Short-term holdings, you'll see one or two.
To that point, by the way, that's a perfect thing for people to look out for, is what's under the hood. And if you look at different, like take two oil ETFs, we have USO and USL. One's the front month, one is the front 12 months. So if it's going up, we're basically only rolling 1/12 of the portfolio at a time. That can mitigate contango, but it also mitigates backwardation. The other thing is the curve is less volatile as you go out. So if you're an investor looking for a short-term pop, even if you're in contango, you might want to be at the front of the curve, because if you're thinking, oh, this is going to go up 10%, something spread out a little bit more might go up 7 or 8%. And yes, it'll protect you from the contango bite, but that might not be what you're looking for. So you really have to ask, what am I looking for here? Do I want the short-term pop? Am I longer term? And if I'm longer term, you probably do want to be looking for something that addresses the contango issue.
So all those are excellent explanations of backwardation and contango, which we thankfully don't have to think about, because physical gold funds,
We have a question coming in for you. Given all the conversation about futures, now people are saying, okay, well, in a physical product, and I think about this personally. My dad has when he was young, invested in gold coins.
Yeah.
Right. And then I remember when he came to me and says, "I've got these coins and I'm not sure what to do."
Yeah.
And I think about how ETFs have solved that problem.
Yeah.
But my question for you and one from the crowd is, when it comes to the gold ETFs, if somebody wanted to redeem their ETF, are they actually getting back coins or bars, or are physical gold? Is physical gold moving around?
Yeah. So our authorized participants is a technical word. They can move gold in and out of the fund. For most investors holding our funds, no, they can't get easy access to the physical gold. But if you're an investor in gold and you don't particularly care about getting access to the physical, it's a great way to get that investment access, because the shares are going to track the price of gold nicely. Now, there are people who, for various reasons, they want to hold just physical gold. They want, like your dad, those coins, and there's a whole market for those folks as well.
Okay, next question that's coming in. They want to understand about corn futures, getting very technical, and how apparently corn futures expire on a specific day across 5 different months.
That's correct.
Is there a particular reason for this? Is this historical?
It's historic, yeah. The corn, all the futures markets evolved to take delivery of physical futures, basically, and provide a hedging mechanism for both buyers and sellers. And so every futures market, whether you're talking about corn or oil or any of them, they evolved with the movement of the production and movement of those commodities. So it's a very natural thing. Corn only has 5 expirations, oil has 12. So, it depends on what commodity you're talking about. So inside the corn fund, we hold 3 different futures out the curve. We never hold spot. And we use December as an anchor month. Now, December is that usually is a very active month, because farmers hedge there. When you're harvesting in the autumn, you want to hedge your December, because that's when you'll have your corn coming out of the field. You'll have your corn to sell. So sometimes we'll own 2 Decembers. And to the point we were talking about earlier, when you're a buy and hold investor, when you're allocating, when you're getting exposure, where people generally want a long-term exposure to gold in their portfolio, they want a long-term exposure to energy. There's some very reputable firms right now adding corn. So happens they're adding corn to their permanent portfolio allocations now. You want to have your money with the professionals. As further out the curve you go, as John said, a lot of people are playing those who are only professionals. The speculators, the people who are reading the headlines, they're playing the front months. But the outer months of futures are really the realm of professionals and hedgers, and that's where you want your money as an investor. You want your money with people who really know that commodity. And that's how we design them. So corn futures, yes, they expire 5 times. We have 3 different contracts, so we're rolling 5 times a year, 1/3 of the position, and again, that helps to mitigate both contango and backwardation.
And for oil, as mentioned, it's expiring 12 times. Is that again a historical piece where people just wanted actual delivery of oil, actual delivery of the product?
The exact same thing. Just the ability to take delivery at the end of every month, or to project it out 3 months, 6 months, whatever it is that you want to hedge and whatever somebody wants to sell to you.
All right, now we're live on the New York Stock Exchange. The markets move when the president speaks. The news over the last few weeks have been tariffs, trade wars, whatever you want to call them. I imagine there's an impact in the world of commodities whenever these topics come up. I'm wondering if each of you could give a bit of a house view of the impact of what's happening right now on individual commodity products.
Sure. Well, first of all, I think there's kind of a couple of ways that tariffs or trade wars affect commodities or may affect commodities. One is the direct impact. So if you put a tariff on a particular commodity, it can cause a dislocation in that commodity, and there can be some price volatility over time. Just to give you an example, just last week, Friday, China put a 10% tariff on liquid natural gas coming from the US. So it's no longer the cheapest LNG or the most efficient LNG for China to get. They have to look elsewhere to buy if they want to get a cheaper price. But they may not find it 10% cheaper than the US. They might find it 5% cheaper. So suddenly their buyers are paying more. And at the same time in the US, we've just lost potentially some export value to China. On the other hand, you have Europe opening up new terminals, and that could be a great story, and be happy to get into that a little bit. But you just have these dislocations happening, and it's very difficult. There's so many factors. It's difficult to figure out exactly what is going to happen in the short term or over any particular short period. Longer term, tariffs, my worry is if they do weigh on the economy, the global economy, and they do start to sap global growth, that would be a negative for commodities in general. That's what we hope not to see, and hopefully cooler heads will prevail in this, and this is all negotiation, and everything will come out better. But that is, as it goes on, it could be a concern. And what we've seen so far, I think that the market has priced in some concerns about tariffs. Just take copper, for example. It was doing very well over the last 2 years. It kind of paused a few months back, declined. It seems to have hit a point of support and is rising a little bit over the last 3-4 weeks. So hopefully, the market's kind of priced it in, and we'll see what's going to happen with different commodities. But it's it's an artificial disruptor that gets in the way of prices, and we'll just have to see specifically how it affects every single commodity.
Sal, how about in the soft commodities? You must be thinking about this.
We've been very busy since we have a soybean fund, SOYB. It got a lot of attention with the tariffs. China is the world's largest importer of soybeans. They are the largest buyer of United States soybeans. Look, everything equalizes. This will all work out. Commodities adjust instantly, their prices. The bottom line is that there are only 3 countries that export enough soybeans to matter: the United States, Brazil, and Argentina. China is now buying all of Brazil's exportable soybeans. They're buying all of Argentina's exportable soybeans. What's happening? Argentina and Brazil are now buying US soybeans, so that their processors for soybean meal have enough to buy. It's a big circle. The price to China right now, whether they buy soybeans in the United States and pay a 25% tariff, or whether they buy soybeans in Brazil on the spot markets and import them, is exactly the same. So the price has already equalized. Those beans will get used. Those commodities will get used. In agricultural commodities, you only grow a certain number of them. The surpluses in agricultural commodities are measured in weeks and months, not in years, and you have growing cycles. So in the autumn, once you harvest, say in the northern hemisphere's autumn, where more than 2/3 of the globe's corn is produced, no corn is growing. During winter, there's a big pile of corn, and it's getting smaller every day because everybody's taking out of it. That's why there are seasonal patterns in commodities. In the autumn, people tend to look pretty hard at corn for that very reason. You have a harvest low because there's this big pile of corn. All the corn comes out of the fields at once, and then none's planted. It's wintertime. There's nothing anyone can do about it. There are only months worth of excess supply. If there were to be a major crop failure around the globe or in some critical producing country of an ag, that ag is disrupted for a year or two because high prices, every farmer in the world tries to plant that commodity and does correct. But The unique thing about tariffs is, yes, they cause dislocations, but the unique thing about tariffs in agricultural products is all the agricultural products, or the vast majority of the agricultural products produced each year, are also consumed that year. So you can put up an artificial barrier, the price adjustments will adjust, and the commodity will get used anyway.
And Greg, I want you to add a bit of your thoughts, but also with a different angle, because you have gold with currency overlays, right? So I think about, you're thinking not just about gold as the investment vehicle and tariffs and trade wars, but also the fact that you've got currencies that are moving around and you have a way to capture some of that exposure.
Sure. Look, I would say gold has been fascinating. Notwithstanding all that's been going on in the world, it's been relatively stable. It hasn't gone up much, hasn't gone down much, but I would encourage investors to really think long term. Go to our website, spidergoldshares.com, State Street Spider website, to see what gold can do for your stock and bond portfolio. And if you're the product you're mentioning, gold with a currency overlay, again, it's economically equivalent to having bought gold in different foreign currencies. That can produce an even less volatile gold component in your portfolio. So I think investors should check those out and think long term.
Gentlemen, thank you very much for spending your time here today, educating me as well as educating all of our audience at home. Investors, I think we hit on what we agreed to do. Whether you were a new investor or someone who's really been in this space for a while, I think we captured a lot of ideas and a lot of thoughts. I'm sure everyone can attend each of your websites to learn more about commodity products. They can come here to the New York Stock Exchange. I just want to say again, thank you for spending your afternoon with us here, live from the New York Stock Exchange, the home for ETFs. I'm your host, Douglas Yones, and I'll see you next time.